Topic 7 is going to be about auto, homeowners, and renters insurance reimburse policyholders for financial losses to their covered property and the cost of legal liability for the damages to other people or property. So first, I'll go over the primary types of losses covered by insurance policies. So auto insurance, it usually covers property damage, which is the damages made to property caused by vandalism, natural disasters, and accidents of the same nature. Liability, which covers financial, legal, and ethical responsibilities. Medical expenses and personal injury protection, also known as PIP, which covers medical costs for insurance holder and passengers, regardless of fault, which would mean who's at fault during a traffic accident. And then comprehensive coverage, which is protection against non-collision related issues, such as theft or vandalism. The next type of insurance policy would be homeowners insurance. Homeowners insurance first starts off with dwelling coverage, which is covering the structure of the home from fires, storms, and accidents. Personal property would be the vandalism and theft of belongings related to the property. And liability coverage would be if the policyholder is found responsible for injuries or property damage to others. The fourth one, loss of use, which is paying for additional living expenses if the home is uninhabitable due to the covered damage. And the miscellaneous, when it comes to homeowners insurance, would be covering detached structures on the property, such as fences, sheds, or extra living spaces. Moving on to renters insurance. First, personal property coverage. This covers the cost of replacing and or repairing damage from accidents such as theft, fires, or vandalism, etc. These tend to be physical property or just property within the renter property. And then the second would be liability coverage. This provides coverage if the tenant is at fault for an injury or damage inflicted on others. For example, a guest slipped in the house or apartment, then the insurance would have to cover the person who slipped, medical bills, and any costs that may relate to the injury that was caused on the property. The last one would be loss of use. This pays for temporary housing expenses if the place of dwelling becomes uninhabitable due to something out of the renter's control. Next, I'll be going over the factors that affect insurance costs. So insurance costs are paid usually in half-year or full-year terms. So first, auto-related incidents. These, you'll be at fault if a driver runs a stop sign and crashes into a family of 4. That's an example. Another example for negligence would be failing to secure items on a truck, which results on items damaging another person's car or causing injuries to pedestrians. And lastly, this type would be DUIs, which is driving under the influence. An example of this would be driving after a party and hitting someone, which causes an injury. These three will all affect the rate of auto insurance for the person being insured. Secondly, homeowner-related accidents. These would be like slip and fall, where the homeowner forgets to clean a part of the floor, causing another person to slip on the property. Or dog bites, which a passerby or neighbor may be bitten by a dog, which causes injury and trauma. These would also cause homeowner insurance to go up, leading to higher rates in a year. Lastly, renters incidents. These would be split into 3 main categories: safety conditions and fire accidents. So fire accidents would be when the homeowner forgets to turn off the gas, stove, or any gas related when they leave the house. Safety conditions falls under where the tenant fails to fix a broken floorboard, which causes a guest to fall through and injure themselves. Another example would be water damage. This is where the failure to report a broken pipe, overflowing a bathtub, or other examples may lead to damage relating to the property. Next, I'll be going over life insurance in topic 8. So life insurance provides funds for beneficiaries in the event of an insured person's death. Policy proceeds are intended to replace the insured's lost wages and or to fund their dependents' future financial needs. So how death may cause financial losses. So the first one would be loss of income. The person who died is no longer able to provide for a family, and this makes it harder to cover expenses. Next would be unpaid debts. Mortgages or loans may burden remaining family members even more than it already is. This also ties into the loss of income, where it's harder to repay debt if the overall family has a lower income. Childcare and education is also a huge one because education costs and childcare expenses may become unpayable. These three are all very essential needs that need to be paid off, which is why we mention it and cover it within life insurance. So, benefits versus cost of insurance. So, the benefits would be financial security for the dependents and people at risk. It provides a lump sum amount to replace the loss of income, like I mentioned before. There's also debt repayment. It helps pay debt in times of loss. And the future, which allocates certain amounts for the family's future, such as a child going to college. The cost, though, is underinsurance risk. Inadequate insurance may leave dependents with unmet financial needs, so if you pay less monthly, you may get less in the future, and that may not be enough to cover family expenses. Overinsurance risk is the opposite of underinsurance risk. This is where overpaying for insurance can cause current financial strains, and if you don't need the life insurance, you may be paying a lot more extra than you already need. Topic 9 describes unemployment insurance, Medicaid, and Medicare as public insurance programs that protect individuals from economic hardships. So first, I'll be going over how state unemployment programs can help reduce economic hardship during pandemics and job losses. So first, they provide income replacement. These programs normally provide partial income replacement that allows affectees to meet basic needs like food, bills, and debts. Secondly, keeping consumers, which allows consumers to spend on basic needs and other goods, which provides a replacement for their lost income. This therefore helps the overall economy since money is still being circulated. Lastly, job searching is a huge one as well. Many unemployment programs require the affected individual to actively search for a job. This helps the economy and encourages the person receiving the money to sustain a healthy lifestyle and to not give up. So there are 3 big steps when it comes to applying for unemployment. First, you would file a claim with the insurance program, and you can do this through online, through a website, or by calling them. You should then check that you have all the necessary information before applying. And then lastly, expect to wait 2 to 3 weeks before you receive your first benefit, which is going to be the cash amount that they do provide. So comparing Medicaid and Medicare programs, first, by purpose, Medicare provides health insurance primarily for seniors and certain disabled individuals, while Medicaid offers health insurance for low-income individuals and families. Eligibility is also different. Since Medicare targets the elderly, it has to be people above 65 years old or people who are disabled under 65. Medicaid is just individuals and families with low income and limited resources. Funding is also different. Medicare is federally funded through payroll taxes, Medicare taxes, premiums, and general revenue, while Medicaid is jointly funded by federal and state governments. The coverage is also different but somewhat similar. Medicare covers hospital stays, patient care, doctor visits, and prescription drugs, while Medicaid covers a wide range like hospital care, doctor visits, long-term care, and dental and vision. So Medicaid does cover more than Medicare. The cost to enrollees is also different. Medicare varies by plan type, and there's financial assistance for the low income, while Medicaid is minimal pricing for low-income individuals, since that's what it's targeted at. The administration is also different, with Medicare being by the federal government and Medicaid being by individual states within federal guidelines. Next, topic 10, insurance fraud. It is a crime that encompasses illegal actions by the buyer or seller of an insurance contract. First, I'll be giving some examples of insurance fraud. So policyholder fraud would be the buyer of the insurance. These could include exaggerated claims, like inflating the price of damages in order to claim more money, faking accidents, staging a car accident to receive the payout for the car damages, arson, intentionally starting a fire to collect on the policy, false injury claims, claiming an injury in a public place to receive liability money from the property owner, fake vehicle theft, claiming a vehicle is stolen when it is most likely hidden or sold. Next, we'll be going over agent frauds. So these tend to be the sellers of the insurance policies. First, there's premium diversion. An insurance agent pockets the policyholder's premiums instead of giving it to the actual insurance company. Fake policies are selling fake or fraudulent policies to unsuspecting buyers. Churning, an agent convinces a policyholder to spend more money on insurance solely for commissions. These three are going to be by agents, which is selling and not exactly the insurance company. Healthcare insurance fraud includes billing frauds, which are bills for fake services not rendered or inflates the price of services. Patient identity theft, using another person's identity to claim money. Unnecessary procedures, a doctor files unnecessary medical procedures to file insurance claims. These three are going to be for medical frauds. The consequences of committing fraud are criminal charges, which is where perpetrators may face criminal charges leading to fines and imprisonment. In some cases, civil penalties. Offenders can be liable for substantial financial penalties and restitution. They may also increase premiums on the insured persons for all policyholders. Loss of coverage. Individuals committing fraud may lose their insurance coverage completely. Damage to reputation. Being caught for fraud can severely damage someone's reputation. Legal costs. Defending against fraud charges can result in significant legal expenses, whether it be through a lawsuit or other means. And the loss of professional license. If they're found guilty, typically on the agent side, they may lose their license to sell other insurance policies. Moving on to topic 11, identity theft and fraud. This is where online transactions and failure to safeguard personal documents can make consumers vulnerable to privacy infringement, identity theft, and fraud. Some scams to be aware of would be online behaviors, which is weak passwords, oversharing on social media. So, for example, your location through posting pictures, and phishing sites, which is where clicking on links on untrustworthy websites can lead to stolen info. Email and text message scams are very common. Phishing emails are where scammers mimic legitimate websites to try and get unsuspecting readers to click, while smishing, which is SMS phishing, uses text messages to lure readers in to click on dangerous links. So you might be wondering, when should I disclose information? So you should disclose information on legit government agencies, for example, taxes, benefits, etc., and financial institutions, sharing account numbers for authorized transactions with trusted banks and organizations. But be aware that there are impersonators when it comes to government agencies and financial institutions, so always verify that it's the real institution and not a scammer. A don't would be unverified contacts. Normally scammers trying to imitate legitimate institutions, public networks. Never put private information onto public Wi-Fi and insecure networks, which makes it easy for hackers to target. Also, don't disclose information when there are unnecessary requests. Only do it when it is required. Also, don't disclose any information if you deem a website suspicious. There are many signs, whether it be a weird or long link, or it may not look like the official website. Next, I'll be giving some tips to reduce fraud. So ensure that you use strong passwords, monitor financial accounts, freeze credit reports if you notice suspicious activity, shred documents that you no longer need but contains important info, update software on devices like your phone, laptop, and home devices, close or freeze hacked accounts. This relates to online accounts or bank accounts. Add a fraud alert to your credit report as well. Contact one of the 3 main credit bureaus, for example, TransUnion, Equifax, or Experian. Some tips to reduce fraud would be to submit a report. First, you would want to visit identitytheft.gov to file a complaint about identity theft with the Federal Trade Commission, also known as the FTC. Submit a police report to the local authorities. Then keep an eye on credit reporters. Get your credit reports for free from annualcreditreport.com, so you'll be able to check on them for any illegal activity. Also, contest false accounts. Dispute the charges by getting in touch with creditors or companies that open bogus accounts. To protect your accounts, on the impacted accounts, change the passwords and turn on 2FA, which is two-factor authentication, which often contacts you through a 6-digit code that you have to put in. It adds an extra layer of security for all of your online accounts. If required, notify the IRS by filling out the IRS form 14039. Moving on to topic 12, which is extended warranties. They are similar to insurance policy. The cost and benefits of extended warranty. So the cost price varies by item. Let's say you buy a cell phone, these tend to be $100 to $200. Well, for a laptop, it's $200 to $500. For a vehicle, these tend to be $1,000 to $3,000, and these contain maintenance and other packages. Sometimes there are hidden fees that you should watch out for. These may include service visit fees or deductibles. The benefits are peace of mind, coverage for repairs or replacements, potential savings, which is saving large out-of-pocket expenses if the item does fail, extended coverage beyond the manufacturer's warranty, so you have extended peace of mind. Compare this to the likelihood of product failure, which is high for cell phones and laptops, which is due to the frequent and daily use. Vehicles tend to be more reliable, but repairs tend to be costly. Costs of the replacing of the item are also very expensive for both. Comparing extended warranty to insurance. Extended warranty is a service contract that extends the coverage period for repairs or replacements of a product beyond the manufacturer's original warranty, while insurance is a financial product that provides protection against potential future losses or damages by paying for certain costs in exchange for regular premiums. The similarities would be both manage expected expenses and the payments for the coverage are the upfront costs, while the differences would be their scopes, which is how warranties cover specific repairs, while insurance covers a broader range, for example, accidents and theft. Their terms also tend to be different. While warranties have restricted terms, insurance tends to be more comprehensive. Duration is also different. While warranties are limited in their duration, being a set period, insurance can be renewed indefinitely.